Hey everyone, Cathie Investor back to another video for today. So let's talk about a stock which has actually helped the ARK ETF outperform the market in 2023. Well, it's one of those stocks that have helped that fund outperform the market. The other one is obviously Coinbase. Coinbase is up, I think, over 300% year to date. But this video will focus on DraftKings. DraftKings is up over 200% year to date, which means if you bought it at the start of the year, you're up 3x right now. Now, I'll try and make the case as to why 2024 might actually still be a good year for DraftKings. The industry is growing, the company is growing fast as well, but of course, it is still unprofitable. They are making some improvements on that as well. More on that later on in this video. But first, let's have a look at the industry. So according to Grand View Research, the global sports betting market accounted for $83.65 billion in 2022 and is expected to expand at a compound annual growth rate of 10.3% from 2023 to 2030. Now, if we look at the US sports betting market, that should also grow by 10.4% CAGR from 2023 to 2030, which if we look at the graph right now, it sits at around $12-13 billion, so it will probably double in the next 7 years. Now moving over to the ARK aspect of this video, this is just a quick reminder. So they previously had in 2022, November 2022, they had 18.2 million shares. The stock price was $14.86. Since then, well, the stock price is now at around $35, $36 or so, and they still have 7.7 million shares. Now, lately they have been selling. In November, they've sold a lot of shares of DraftKings, but it still is the 11th largest position in the ARK ETF. So what made DraftKings go up 3x in 2023, and what could make DraftKings go up another 2x in 2024? Well, first of all, as we've seen, they are in a growing industry. Whether it's in the United States or globally, they are playing a part there. Second of all, the company itself is growing extremely fast. Third of all, despite being still unprofitable, they are making some positive moves towards profitability, and we might actually see it already starting at the end of next year. Now, of course, I'm talking about EBITDA profitability, so not net income profitable, but that's already a first good step. We might see cash flow from our operating activities be positive in 2024, which is also a positive indicator. Now, before I continue, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Do share your thoughts on these companies down in the comments below. And if you want to support me even further, do check out the link down in the description and the pinned comment to the top 10 best stocks to buy now, or go to full.com/couchinvestor. Thank you very much. So, jumping quickly into the latest earnings report, we can clearly see here how fast this company is growing. So they increased revenue 57% year over year to $790 million. That's not all. They achieved the #1 US online sports betting and iGaming gross gaming revenue share in the United States in Q3 at 33% share, increased over 1,000 basis points over the last 5 quarters. Their fiscal year 2023 revenue and adjusted EBITDA expectations are increasing by $195 million and $100 million respectively, inclusive of the anticipated launch in Maine. More on the launches and expansions a bit later on. They introduced fiscal year 2024 guidance. They also have $1.1 billion of cash and expect to have more than $1.2 billion at the end of this year before generating substantial positive free cash flow in fiscal year 2024. Now going back to the guidance. So first up, the company's updated revenue guidance for 2023 equates to year-over-year growth of 64 to 66%. So yes, we're talking here about a high growth company, a high growth stock. Then the company now expects fiscal year 2023 adjusted EBITDA of between negative $95 to $115 million, and that's a huge improvement from the negative $190 to $220 million previously. Then for fiscal year 2024, revenue guidance should increase by more than 25% year over year. They also introduced fiscal year 2024 adjusted EBITDA guidance of between $350 to $450 million. So as you can see, with regards to adjusted EBITDA, of course, we are seeing some major improvements from a loss to already quite a substantial amount of positive adjusted EBITDA in 2024. And so if we look at the big picture right now, this is a company that has a market cap of $16.4 billion. Year to date, it's up 210%. Of course, there's no forward PE right now, but if you look at EV to sales in the next 12 months, it trades at 3.8 times, EV to EBITDA 65 times. Now, if we look at the analyst estimates, the growth rates for fiscal year 2024 and 2025, we can see that analysts are expecting sales to increase 25.1% in fiscal year 2024, EPS to be 8 cents. But then in fiscal year 2025, you can see sales growth of close to 20% again, but EPS has increased more than 10x. As we turn to the average price target, that currently sits at $39.6, which means it's 12.12% higher than the price we're at today. Of course, as we know, price targets change over time. Now, you're starting to understand why this stock has outperformed quite a lot of companies already in 2023. Of course, mix that with the fact that it was trading at an extremely cheap valuation at the start of the year. I believe the stock was also trading at around $10, $11 or so. So yeah, the market cap there for the potential of this company, for the revenue that it could generate and is generating right now, I mean, didn't really make that much sense. But of course, as we know, at the start of 2023, at the end of 2022, a lot of valuations did not make a lot of sense. It was a constant doomsday scenario type of headlines for each and every company. So yes, that was dragging down even successful companies. So yes, even if this company wasn't doing that much right, the stock would have gone up just like the overall market. But since it has outperformed the market by quite a lot, let's dive a little bit deeper. So in their investors presentation, they showed us why they're becoming actually more profitable as they continue to outgrow a lot of other companies out there. So over the past 2 years, we have dramatically increased customer acquisition while simultaneously decreasing customer acquisition cost. As you can see, the CAC from 2021 to 2022 decreased 21%, and now it decreased another 20%, all the while customer acquired grew 40% CAGR since 2021. And then when you look at this slide right here, they expect adjusted EBITDA of $1.4 billion in 2026 and $2.1 billion in 2028 from existing states alone. So revenue increased quite nicely, but here you can actually see why the market is suddenly giving it a little bit of a premium. Adjusted EBITDA increasing quite a lot, and so does adjusted EBITDA margin. They expect 30% adjusted EBITDA margin in 2028. And why did they mention just by the existing states alone? Well, because right now, not all states have legalized online sports betting and iGaming. As more and more states move to legalize it or not, remains to be seen, more and more revenue, more and more customers become available for this company, which they visualize right here. So there is potential for up to an additional $6.2 billion of annual adjusted EBITDA to DraftKings from future online sports betting and iGaming legalization in the United States. They do give us a couple of scenarios here. So of course, the remaining of the United States give you that 6.2 billion, but at 30%, you're sitting here at 2.5 billion. If you want to be conservative, maybe you should go with a number closer to this. But right now, you can clearly see that their strategy is clearly working. The number of unique customers on the platform is rising and rising quite fast since 2020. This leads me to the graph. This is on the monthly. I'll show you the weekly in just a second. With the monthly, we can see maybe this being a cup and handle pattern in the making. I mean, of course, this year, like I said, it's been quite a good year for the stock. Only 3 months of red followed by a huge green candle. Right now in December, we are starting it off with a bit of red. If we switch to the weekly, you can see that we were peaking at around $39. We were also a bit overbought right there. If you want to know, the 200-day moving average sits at around $28. If you're looking for a better position, of course, look out if it breaks down under the 50-day moving average. Maybe it can make its way towards the 200-day moving average at around $28, which was also a type of base-ish back in the summer. So overall, what you're getting here is a company that is growing quite fast, that is moving towards profitability, and that is in a market that is also growing quite fast. Of course, there is risk of legalization of online sports betting, iGaming as well. If that does not materialize, then yes, you will have a ceiling. But so far, so good. Of course, do share your thoughts down in the comments below. Do you hold this company or maybe any other betting company in your portfolio? Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.